Before you take a trade today, let's take a moment to get your mindset right. The difference between success and failure in trading often comes down to your psychology, not your strategy. In this video, I'm going to share the key mental shifts that you need to adopt every day before you start trading. These shifts will help you stay disciplined, manage risk, and avoid emotional decisions that can cost you money. Many of the shifts and concepts we are about to cover have been adopted from two of the most prominent figures when it comes to mastering trading psychology: Mark Douglas and Jared Tendler. I have taken the time to organize their most important ideas and frame them in a practical manner that we can all remind ourselves of every day before we trade. So if you want to improve your trading mindset, stick with me for the next few minutes. I'll walk you through the essential psychological principles that you could implement right now to give yourself a better chance of success in the markets. Let's get started. First things first, the market is random. You can't predict every move. No matter how great your strategy is, there will always be uncertainty. And that's something you need to accept. This is a concept Mark Douglas talks about often. Anything can happen. That doesn't mean you can't be successful, but it does mean you need to understand that trading isn't a perfect science. Imagine this scenario. You've been trading for a while and your strategy has worked for you in the past, but then out of nowhere, the market moves in a completely unexpected direction. The worst part, you weren't prepared for it. This is a perfect example of why trading should never be seen as a prediction game, because at some point, no matter how well you think you know the market, it will throw a curveball. By accepting the randomness of the market, you free yourself from the emotional pressure to predict the next move. Instead, focus on managing risk and following your strategy. Even when the market seems unpredictable, the more you embrace the randomness, the more comfortable you'll be when things don't go as expected. Trading is about probabilities. Every time you place a trade, you're playing with odds, not certainties. Mark Douglas describes this well. An edge is nothing more than a higher probability of one thing over the other. It's a game of numbers, and your strategy should be designed around playing the probabilities, not trying to win every single time. Think of it like flipping a coin. If you've got a strategy that gives you a 60% chance of success, that means over time you'll win more than you lose. But that doesn't mean every trade will win. You might lose 3 or 4 in a row, and that's okay. That's part of the game. For example, let's say you're using a strategy where you enter on pullbacks in a trending market. Some trades might go against you, but that doesn't mean your strategy is bad. Over the course of 100 trades, you'll likely see that your edge plays out. You don't need to be right every time, you just need to be right more than you're wrong, and manage the risk on the wrong trades. When you trade with this mindset, you remove the pressure to always win and start focusing on the long-term success of your strategy. And when you do this, you'll approach each trade with more confidence, knowing that the odds are in your favor. One of the hardest mindset shifts is letting go of the need to be right. So many traders enter a trade with the mindset of proving something to themselves or others, proving they're right. But this is dangerous because when you trade with the need to be right, you'll start making emotional decisions so much easier. Let's consider Jane, a trader who entered a trade with high confidence. She was so sure the market would go up, but it didn't. The position went against her. Now, if Jane's focus was on being right, she might have held on to the trade, hoping it would reverse, but this emotional attachment of being right often leads to bigger losses. In trading, the goal isn't to always be right. It's to trade with consistency and discipline. When you stop worrying about being right, you can focus on what really matters: executing your strategy. This frees you from emotional decision-making, so you can move on quickly from losses and stick to your trading plan. One of the most important concepts to understand is that trading is a risk management game. If you're not managing your risk properly, it doesn't matter how good your strategy is. You'll eventually lose more than you gain. Imagine you're risking 2% of your account on each trade. That means for every trade, you can handle small losses without worrying about blowing your account. But if you risk too much on each trade, say 10%, even one bad loss could set you back a week of profits. Mark Douglas stresses that controlling your risk is crucial for long-term success. Your risk management plan should be the first thing you set before entering any trade. If you're consistently limiting losses, you'll be able to stay in the game long enough to let your strategy work in your favor. When you're in the midst of a losing streak, it can be tempting to think that your strategy isn't working. But that's a trap. Mark Douglas teaches us that you should evaluate your performance over a large sample size of trades, not just a few. Let's say you've taken 10 trades this week. If 3 of them are winners and 7 were losers, that doesn't tell you much. But if you review 50 trades, you'll get a much clearer picture of whether your edge is working or not. 1 or 2 losing trades don't define your strategy. It's the consistency over time that counts. This is why I use a software like TradeZilla, or really any other tracking software, to track trades and data over time. All I care about is the bigger picture, and I think you should too. I'll link TradeZilla below because that's what I use, but feel free to track it all on your own spreadsheet if that's what works for you. By looking at your results over a bigger sample of trades, you can start making objective decisions about what's working and what's not. This will also help you avoid making emotional decisions based on a few bad trades. Now let's bring in some trading psychology concepts from Jared Tendler, a mental performance coach who works with traders. His ideas focus on developing mental resilience, controlling emotions, and staying focused, all of which are crucial to your trading success. One of Tendler's core concepts is mental toughness. It's not about avoiding mistakes, but about how you recover from them. Every trader makes mistakes, but what separates the winners from the losers is how quickly you bounce back. If you dwell on a loss, it can affect your next trade, but if you can let go and refocus, you'll approach your next trade with a clear head. Tendler also emphasizes self-talk. How you talk to yourself during a trade or after a loss is critical. If you constantly tell yourself you're bad at trading or this isn't working, that negative reinforcement will hold you back. Instead, focus on positive, constructive self-talk. Tell yourself, this is part of the process, or I'm learning from this. One of my biggest takeaways from Tendler's work has to do with emotions when trading. Emotions are not the enemy. Actually, they're quite the opposite. When you trade, you're going to feel emotions. It's inevitable. So rather than hide from them, why not use them to your advantage? If you're feeling rage or anger, jot it down in a notebook. Make logs of your emotions before, during, and after trading. Once you start doing this, you can start to connect some dots. What does my trading performance look like when I'm very sad? What about when I'm angry? What about when I'm happy? Use this log to make your next move. Think of it like journaling your trades, but for emotions. Next time you feel an emotion that you know is historically good or bad for your trading, use that information to your advantage and either place the next trade or know when to log off. Lastly, Tendler talks about focus. Distractions in trading are common. Social media, news, and the fear of missing out. But true success comes when you can stay present and focused. Tune out the noise, stick to your plan, and stay grounded in the present moment. So here's the takeaway. Trading is a game of probabilities, not predictions. Accept the randomness of the market. Focus on your risk management and let go of the need to be right every time. When you treat trading like a process and focus on your strategy, you'll improve your chances of success. But more importantly, you'll stay calm and disciplined no matter what happens. Remember, it's not about winning every trade. It's about sticking to your plan and letting the probabilities work in your favor over time. If you found this helpful, hit that like button, subscribe, and save this video so you can watch it before your next trading day. Let's make sure you approach your trading with the right mindset each day. See you guys in the next one and trade well. Peace.